So thank you very much, Darrel. It's very early. So I'm going to say a few very brief words of introduction. Well, Darrel Duffie is one of the persons I respect and admire the most. And his work is amazing and has influenced me a lot, but many, many other people. He has a special knack of writing extremely elegant models that also are very innovative and help us understand the world better. So thank you very much for all this, Darrel. You're an inspiration for us. And now I should leave the floor to more important stuff.
Bruno, I can return the compliment to you. It's always a great honor to be with you on the same podium. And hi, everyone in Paris. I was just in Paris 2 weeks ago, and I'm sorry I missed you in person this time. But I'm back home in Palo Alto, California, and delighted to have the chance to talk about digital currencies and policy issues. I'm hoping to finish my remarks in time for lots of discussion. So let me get started right into this. I know this is a really hot topic. I saw John Frost a few moments ago. I'm going to use some of his material. There's just, everybody is working everywhere on this topic right now. And as you know, over 100 central banks are exploring this issue. And I want to kind of slow down the conversation and ask what is the problem in search of a solution? Because we've all heard of that CBDC may not be a solution to any particular problem. I actually think it is, but it's not the only solution. I'm hoping you can see my slides now. And I'm going to turn to the use case that everybody is probably thinking about first, which is prototypical Alice and Bob. Alice needs to pay Bob $8 because she needs to buy a loaf of bread at the local bakery. And the question is, how is she going to pay for the loaf of bread? And for literally several hundred years, since at least the early 1600s in Venice, a method has developed that is now the dominant method around the world, which is that Alice sends a message to her bank, instructing her bank to take $8 out of her account and to credit Bob's bank for $8 for his account. And then eventually Bob will get the money and be able to spend it. I say eventually because the system is pretty slow and it's also quite expensive for Bob. He ends up in the United States paying about 2.5% of the $8 or 2.5% of payments to get the money, and he gets it a day or two later. And that's not very good. Moreover, if Bob is in another country, it's much worse. Cross-border payments are extremely slow and painful and expensive. And so this bank-railed payment system, by which in modern times, the central bank accumulates these flows between banks and then they're settled in central bank deposits. This is this payment system is being called into question. And it's been suggested that it's too expensive and too slow. This is a chart based on data from McKinsey. I did a rough calculation of payment revenues in the United States and Canada. That's about 2% of GDP versus Europe, Middle East, Africa, about 1.6%. And you can see the two payment stacks are quite different. North America, the payment stack is heavily weighted towards consumer costs. And you can see the large block at the bottom for credit cards is particularly bloated in the United States. And the reason for that is competition issues. The more competition there is, the more that the credit card companies increase the charges to Bob, the interchange fees, in order to keep Alice in the network by giving her rewards. This is what two famous French economists, Jean-Charles Fauché and Jean Tirole, call a two-sided market. So Alice is on one side, she's being subsidized to stay in this market. Bob is paying to keep Alice in through his interchange fees, with rents, of course, going to the banks and the credit card companies. In Europe, as you can see on the right-hand chart, or the rest of the world, credit cards are not so big. In Europe, they're particularly small, about 1/3 of the North America amount. And that's because Europeans have figured out to regulate the interchange fees. So that's just one example of a use case in which the existing bank rail payment system is not working very well. And many have suggested that what we should do is move instead to a central bank digital currency, which is much cleaner. Alice simply instructs the central bank to take $8 out of her account and put it into Bob's account. And the way that it's depicted here is the way that it will be implemented in most countries, including China already. Alice's payment service provider, which could be her bank, is going to take responsibility for managing her CBDC account and giving her account services, and likewise for Bob. But this will be a real-time gross settlement system by which Bob gets the money instantly at low cost and no credit risk. So what's not to like? Isn't this the solution to many problems? And yet critics like two Federal Reserve governors have called this a solution in search of a problem, because Bob and Alice can already do this using the bank rail payment system, they would say. Mervyn King, the former governor of the Bank of England, who is now chairing the House of Lords subcommittee on this issue, to which I testified, also called this a solution in search of a problem. And it is true that there's nothing particularly important for the moment that a CBDC can do that a bank rail payment system could not do. All of this could happen on the bank rail payment system. Bob could get paid instantly at low cost. So is it a solution in search of a problem? What is the problem? The problem is competition. There's not enough competition in payment services markets. And so we're getting weak innovation and rent-taking along the payment rails. CBDC is one option to spur competition. Banks will probably respond to the introduction of CBDC by competing for Alice's and Bob's services and offering them lower cost, faster, better service. But is that the only way to get competition and to improve speed and efficiency? Maybe not. One of the other proposals is to go to a digital currency called a stablecoin. We've all been reading about Terra and how it collapsed, but nothing rules out a good quality stablecoin that's stable. Alice, as you can see in this diagram, simply pays $500 to get 500 stablecoins, and then she can pay Bob directly without going through the bank rail payment system. And this might be coming into the real payment system, not just for cryptocurrencies, in the area, first, I would guess, cross-border payments. Business to business and peer-to-peer cross-border payments can be made much more painlessly this way, but that's not to rule out a bank rail payment solution as well. When the United States investigated this, the President's Working Group on Stablecoins reported that there should be legislation requiring that the only issuers of stablecoins should be regulated depository institutions. So insured depository institutions, which is another name for banks. And when Federal Reserve Governor Chris Waller read that, he gave a speech saying, well, how does this improve competition if stablecoins can only be issued by banks? Because bank competition is the problem that needs to be solved. Now, on the other hand, if you don't have regulation, bank-like regulation that protects the assets backing the stablecoins and the stability of the banks that are issuing them, can this be a stable solution? There are also some remaining technology issues that Bruno and I have discussed with respect to the stability of the blockchain itself. So this is a possible future for avoiding the bank rail payment system and creating a more competitive and innovative environment. But there's yet another solution that I want to talk about, and that's a real-time payment system, a fast payment system for the bank rails. So the same payment systems that were developed in Venice in the early 1600s at Banco del Giro can still have another generation of improvements through the fast payment system that is coming into many countries, as I've illustrated here. Fast payments are defined by the fact that they're open 24/7, 365. You don't have to wait for the payment system to open for Bob to get his money. And it's real-time gross settlement, meaning Bob gets the money instantly and he can spend it instantly. He doesn't have to wait for his bank to clear it for access. Among other countries, the United States already has a fast payment system called RTP, but this payment system was put up by the largest banks. It does cover a large fraction of deposits in the US, but it only covers the largest banks. And because it's managed by the largest banks, in my view, it's not providing the competition that's needed in the US payment system because, I mean, frankly, if I were the CEO or chair of one of the large US banks, I would not put a fast payment system up in competition with my credit card business because then my shareholders would make less profits. And there's nothing morally incorrect about that. It's up to the regulators to make sure that fast payment systems are introduced into the bank rail payment system in a way that creates more competition. The Federal Reserve in the United States, not satisfied with the bank-based fast payment system, is introducing its own called FedNow, which will be out in a year or two. But again, I'm worried because FedNow seems to be a system that will be provided to banks so that they can choose how to provide fast payment services to their customers. In other words, if you're, again, the CEO of a large bank and you're thinking, wow, I have access to this back-end fast payment system, now I can provide payroll services to my favorite commercial customers, or I can allow my retail customers to do peer-to-peer payments. I'm probably not going to make it all that easy for my customers to use these payment services instead of credit cards. I'm probably not going to make it all that easy for them to move their deposits out of my bank and into another bank that's using the fast payment system. The interoperability issue of, what will the Bank of America app look like and what will the Citibank app look like and will they interoperate? Whether this introduces competition, I'm somewhat doubtful, at least as currently planned. However, Brazil has introduced a fast payment system called Pix that I want to spend a couple of minutes on, which I think does have the potential of doing much of what a CBDC could do. So this is a small schematic of what the Pix system looks like. In this case, Alice will be able to send Bob the money directly using the Brazilian fast payment system, but through an app called Pix, which is available now to essentially everyone in Brazil. In a mere 2 years, almost every adult in Brazil has decided to get the Pix app, and Pix is now accounting for a larger fraction of payments than credit cards by far. The central bank is not involved in the same way that a central bank would be involved in CBDC. This is a commercial bank railed payment system. The AML, KYC, CFT, sanctions, checks, and all of that are still being done by the banks. The central bank is not being required to do all of that. And the issue of CBDC displacing deposits and causing problems with credit provision doesn't come into play here because this is, again, a bank deposit-based payment system. This is a chart from John Frost, who spoke earlier today, and his collaborators at the Bank for International Settlement. I took their data and replotted it so that you can see easily that Pix is picking up much faster than fast payment systems in other countries. And the main reason is this single interoperable app. Everybody in Brazil using the same app so that it's easy for Alice and Bob, no matter who they are, to move money back and forth between each other. The number of transactions per capita has been zooming I learned recently at an IMF meeting in Zurich that this system now has brought into the payment system an additional 5 million Brazilian households who had not had payment services. They didn't even have bank accounts. And an additional 10 million Brazilians who had been relying on paper money are now being brought into digital payments. The cost of introducing this Pix app, $5 million. CBDC could accomplish everything that Pix is doing, but in the United States, I'm predicting it's going to take a very long time before policymakers and technology developments allow that. And in the meantime, I think a fast payment system is a very effective device. This is another chart from the same paper by John Frost and his collaborators. And you can see that in Brazil, credit card interchange fees are still quite high, but merchants that use Pix are getting their payments for about 20 basis points, much less than in the United States or in the case of Brazilian cards. Europe, as I mentioned earlier, as you probably are all aware, has a regulated interchange fee on cards. So it already has a low cost to merchants relative to the United States and Brazil. But Pix is a way to introduce competition into payments that doesn't necessarily require caps or regulatory caps on interchange fees. The flip side of the cost of a weak payment system, a weakly competitive payment system, is the bad deal that consumers and businesses get on their bank deposits. And that is also true in Europe. When wholesale rates are high, and they're going to get high real soon, again, this is the last time that they had a local maximum, April 2019. But when they get high, depositors in commercial banks don't get remunerated in the same way that wholesale investors get remunerated at the central bank. 240 bips for banks, a mere handful of bips for depositors in banks. And why is that? Because deposit competition is very weak. Consumers are incredibly lazy about trying to find a better deal for their bank deposits. They think of their transactions account as a utility and it doesn't need to get much interest, and they're not really patient enough to shop around. If you had a fast payment system, however, I would predict that is as effective as the one that Brazil has. I would predict that remuneration of bank deposits will rise, and depositors will get a better deal because of better competition in the deposit market. So what are the implications of that? Well, if you took Economics 101, your first reaction might be, well, that's good, because if you have more efficient matching of savers with borrowers, then you're going to get a more efficient allocation of liquidity and capital in the economy. However, that's not the suggestion of many. The suggestion of many is that if banks are able to get deposits funding at very low interest rates, then they're going to offer borrowers better deals for loans, and credit provision is improved, they would say, by having weak competition in the deposit market. In this case, Alice is not shopping around. She doesn't probably have accounts at many banks, and they sure don't make it easy to move your money around currently. They wouldn't be able to prevent you from moving your money easily with a CBDC or a fast payment system that works really well, like Pix. Here's what the Federal Reserve said earlier this year about this issue. They are worried about the impact of a CBDC, and I would say they would have the same problem with a Pix-like fast payment system on credit provision. The Fed said, quote, a widely held CBDC would reduce the aggregate amount of deposits in the banking system, which could in turn increase bank funding expenses and reduce credit availability or raise credit costs for households and businesses. BIS and the G7 central banks said something similar a year before. So central bankers around the world, if you hear them discuss the benefits of CBDCs, they will always say, but we're concerned about credit provision and we're committed to doing no harm to the banking system. It's going to be very difficult to have an effective CBDC or an effective fast payment system without disrupting bank deposits. And now the question is, what does that do to credit provision? Here's the image that is concerning those who would say that this will lower credit provision. So on the vertical axis here is the marginal loan profit to a bank for lending and the marginal funding cost to a bank for borrowing from its depositors. And we're taking the simple case that supports the concern in which the bank is a monopolist, or you could extend this to the oligopoly case. And the monopolistic bank in this case is going to choose the amount of deposits that maximizes total profits, which means marginal loan profit and marginal funding costs are going to be equated. That's the first order condition for that problem. If the cost of deposit funding goes up because of improved competition in the deposit market, then the quantity of deposits taken and the quantity of loans made will go down. And that's the simplified story that backs up the claims of many that if you improve the speed and efficiency of your payment system with a CBDC or a really effective interoperable fast payment system, or maybe stablecoins, then credit provision will go down. So this becomes a macroeconomic concern about transmission of monetary policy into credit provision. However, while I'm a little bit concerned about the lack of time remaining this morning, and I'm not going to go further into the economics of this, there is very good research now available that suggests that this concern is far too emphasized. The reason being is that banks don't rely entirely on funding from depositors. They also have access to wholesale markets, and banks that are accessing wholesale funding would view that as their marginal cost of funding. If the cost of deposit funding, which is much cheaper, goes up, the marginal loan that gets made is still the same. Let me repeat that because it's an important point. If you're a large bank, like one of the large European and US banks that is accessing wholesale funding markets, when you're thinking about the next loan that you're going to make to Bob, you're comparing that to your marginal funding cost, which is much higher than your deposit funding cost. The difference between the wholesale funding costs and deposit funding cost is a profit, but it's not and that profit will go down if you introduce fast payment systems or CBDCs, but it's not going to change the marginal loan. Now, in reality, the world is a mix of the two, the smaller banks and other banks that are not using wholesale funding at the margin, and the large banks. The most recent research by Tony Whitehead, Wu, and Xiao, I learned about this from Kai-Rong Xiao, suggests that when you realistically calibrate the US economy, both small banks and large banks, the introduction of a CBDC has a small but not zero impact on credit provision. Now, whether that's welfare enhancing or welfare reducing, I'm not going to be able to guess, but I think the claims that credit provision will be seriously harmed are much overemphasized. So let me skip through the remaining argumentation and go to my last slide and then open it up for discussion. I've been talking to policymakers around the world and central bankers around the world about this problem, and I have a pretty good idea of what they have in mind. And based on my analysis of this problem and my discussions, here is what I would say if asked, what would you do? The first thing that I would do is to go for the easiest, lowest hanging fruit. Not to say that it's simple, but I would improve the bank rail payment system by introducing fast payments and regulations designed to improve competition, because I think that is the problem in search of a solution. The second thing that I would do is to further spur competition and innovation by allowing entry into the payment services market by appropriate fintech, narrow banks, neobanks, stablecoins, and other new providers of payment services, subject, of course, to compliance and interoperability standards that are appropriate guardrails for making sure the payment system is safe and that investors are protected. I would suggest continuing, however, the development of CBDC technology. I don't think it's wrong to investigate CBDC technology. It is the promise of the future. In the future digital asset economy, it's hard to imagine that in a decade or two, we won't be looking for significant smart contracting infrastructure upon which the digital asset-based economy can ride. Now, that's not to say banks can't develop stablecoin-based deposits that would serve many of the smart contracting needs, but if central banks were to ignore this technology and let banks continue as they choose, then they might regret not having this technology 5 or 10 years from now. And it's going to take 5 or 10 years to develop it, in my view. So they should get started right now and invest significantly in CBDC technology. In the meantime, wholesale CBDC could be a solution to cross-border payments. And I'm sure you're going to be discussing that today, and wholesale security settlements. I view that as a separate issue because it doesn't involve as much in the way of the industrial organization of banking markets and payment service markets. And then finally, although I haven't had a chance to discuss it today, the introduction of stablecoins or CBDCs has very important implications, not just for improving cross-border payments, but also for allowing the invasion of foreign monetary systems with digital currencies that could mess up the effectiveness of monetary policy in small open economies. Now, in some cases that may be warranted, but in many cases it would be difficult for an effective monetary policy in a small open economy if dollar-based stablecoins or perhaps euro-based stablecoins or central bank digital currencies or renminbi-based stablecoins or CBDCs were to allow to roam freely in any foreign monetary system. So I think in this area, the risks should be considered carefully, and international agreements should be discussed at the G7 or G20 level and implemented in Basel standards. But that's a much longer conversation, and we're not going to have time for that today. So I'm going to stop sharing the screen and look forward to whatever time we have remaining for conversation. Bruno, do we have any time left?
You know, the next paper is my paper, so I think we have no time. No, I'm joking. We have a lot of time, so please. Hi,
Darrel. Oh, wow. Hi, Darrel. Thanks for the presentation. I want to come back to something that you said very early, and I think this goes to your slides about in particular, the high cost that credit cards and credit card fees and transactions cost. So there's two things. I think first, as a comment, I think it's really important to understand that the people that actually benefit from these points the most are usually wealthy people, because we get the credit cards with all the perks, and we're causing the highest costs on the system in a way. And at the same time, because retailers have to somehow recover their costs, they actually put this on the entire cost of every transaction. And so the poor people who actually usually use cash actually pay more for it. So actually, in a way, this is like the worst part of the redistribution from poor people to wealthy people. So I think this is actually a social problem, generally speaking. Now, the problem that I see, though, is how would you solve that problem with a fast payment system? Because I still get my perks. Is there not a better way to address that with a regulation of, for instance, nullifying contracts which require or which prevent the retailers from actually giving discounts to people who use cash or cheaper systems?
That's a great question, and a very perceptive one. And I asked the same question to the head of the Brazilian Central Bank a few weeks ago, Roberto Campos Neto. And he had a couple of good responses. One is that Alice is still interested in using her Pix app because she gets all of the data about all of her accounts, all of her balances, interest rates, and her transactions on one app. And according to Roberto, Alice loves this service and she uses Pix. The other thing which actually supports your point, the premise of your question, which is that in Brazil, interestingly, the amount of payments by credit cards has been very stable through the introduction of PIX. It hasn't gone up a lot, it hasn't gone down a lot. So it's kept its market, and I think you're exactly right that it's the elites, the wealthy people that are getting rewards on their card services that are continuing to use those card services. But what we've seen in Brazil, that it helps the lower income groups by bringing them into the payment system with a basic payment service that they're not getting credit cards, but they're using PIX. The financial 5 million additional households have been brought into the Brazilian digital payment arena. Well, actually 15 if you count the ones that already had bank accounts but weren't making digital payments. And they are getting very cheap and fast, effective payment services, even though they're not using credit cards. And Roberto noted that total payments in the system have gone up enormously because of PIX. So credit cards staying the same, total payments way up, financial inclusion way up, and the cost of payment services to Bob the merchant going way down on average, even though he's still paying a big interchange fee for cards. So I think they can coexist. But I asked exactly the same question that you asked to Roberto, and I think his answer seems pretty convincing to me.
Yeah, Darrel, you mentioned the big banks and the role they play, but in some ways, isn't it true that because the bank is able to take the deposit and create higher yielding assets where they can place the deposit? So the smaller the bank, the mom and pop or the credit unions cannot do that. So my thesis is it's also true that the big banks can pass on more to the consumer in that sense because of the structured product. As you know, Marcus by Goldman, raised over 20 billion, although, and they pay the highest. So I would say in some cases, the big banks are needed as well, don't you think?
Yeah, you've another very perceptive point. And I suggested this experiment to Kai Rong Xiao for his new paper, and he then ran the numbers, and exactly as you predicted, the smaller banks are the ones that suffer the most. Their deposit funding costs go up like the rest, but they don't rely on wholesale funding. They rely much more on the consumer and business deposit funding. And they also have high fixed costs relative to their balance sheets, and they are going to be adversely affected. And when you run the numbers, the credit provision by small banks goes down. So that's a negative. On the other hand, there's always another hand. If you introduce, let's say, a PIX-like fast payment system, the small banks can now compete in terms of IT to keep their customers, because they're offering their customers exactly the same app that the largest banks are offering. In Brazil, every bank with at least 500,000 customers is required to provide account services through PIX. And because of that, everybody has adopted PIX. The small banks have jumped on as well because they want to offer their customers the same service that everybody else has. And now, for essentially no cost at all, they can provide payment services with the same very popular app that the largest banks have. In the United States, without that, the small banks are going to get left behind, even without a CBDC or an improvement like PIX, because they just can't compete on IT. The largest banks in the US have IT budgets of between 12 and $20 billion a year, whereas the smallest banks, consistent with your point, just can't keep up. So they're going to get disrupted no matter what. I would say help them along by putting everybody on an even playing field with a highly interoperable common app to which everyone must connect. And that may not keep many small banks from failing, but at least you will get I think the improvements in efficiency in the payment system, and you'll help the small banks last, or the most efficient ones last longer than they otherwise would.
Maybe we have time for a last question.
Yeah, hi there, wonderful talk, thank you. I felt that the momentum behind CBDC really accelerated once Libra and the Libra project started. The Libra project eventually died, maybe due to maybe it was regulated out of existence. And so maybe we still see a wholesale CBDC, but let's say we go through your list of advice to the central banks, and they do that. They have sort of versions of PICs in the United States and Europe. Do you think that the retail CBDC will still be introduced? Is there still a case for that, or is that dead now? Is the momentum shifting?
Well, in my conversations with central bankers around the world, I found that almost to with one or two exceptions, China and Brazil, almost every central banker that I've spoken with is highly skeptical that a CBDC is needed. But as you hinted, they're worried about other innovations that might force their hand, like Libra or Diem, which in the United States has been stopped cold by regulators from entering the payment system. So central bankers by nature are very conservative. They don't want to run an experiment, like mix a bunch of chemicals into their payment system, stir the beaker up with all these new innovations and see what happens. Central bankers are not experimentalists. They want to keep it conservative and not risk, for example, a big negative impact on credit provision. So I don't think there's much of a tailwind behind CBDC. Central bankers will continue to develop it just in case it's needed. That's what almost all of them are saying. So is there eventually a use case, especially is there a use case once you do improve the commercial bank payment rails with, let's say, a highly interoperable fast payment system? I think eventually, yeah. I think eventually it's hard to imagine a world in which central bank electronic money is not widely available for at least a wide range of use cases. But I think eventually it could be a long time. Smart contracting, digital ledger technology, the Internet of Things, wholesale for sure, settlement services, cross-border exchange of foreign exchange. You can imagine a bunch of use cases that will eventually call for CBDCs. And I have a hard time believing that it will never happen. But I do think it lets the pressure off if central bankers focus in the near term on improving what's there rather than putting all of their eggs in the basket of a CBDC technology, which is yet unproven and needs development. So invest heavily in the development of the technology. It's an American option. Exercise the option once it's ready and needed.